Good morning and welcome to the Market Prep. Today is Thursday, July the 20th. My name is John Hoagland. As always, thanks for trusting me with your time. And we are going to be focusing on seeking accurate context, always thinking about risk management and remaining patient in our trading. So, see, it's Thursday already. It seems like this week is really flying by. I'm feeling a little under the weather today, but that's okay. We'll get through this trading day one way or another. Economic numbers this morning. The jobless claims numbers came out. If the average is of lower for 4 weeks in a row for the initial jobless claims at 237,000. The actual was expected at 242,000, came out at 228,000. So a lot fewer initial jobless claims in the last week. Continuing jobless claims, however, were higher. They were looking at 1,729,000, came out 1,754,000. Perhaps even more impactful than that was the Philly Fed number. The Philly Fed has been lower for 11 months in a row, and it's lower than they were expecting this morning. They were looking for -10, -13.5. So manufacturing continuing to retract in the Philly Fed number there. We're still waiting for the 9 o'clock existing home sales and misleading indicators. 9:30, of course, the nat gas numbers come out. Stock index futures were mixed early. They've come off a little bit more this morning with the Nasdaq the weakest after mixed earnings, I guess, from Netflix and IBM last night. Tesla shares also fall on potentially smaller margins. Elon lowered the price for the cars and to improve sales, but it didn't do much for the margin. So the market really kind of digesting that. Today is another busy day in earnings. We're looking at Johnson & Johnson, Abbott Labs, Philip Morris, all of them beating expectations this morning. I think overall our earnings have been overwhelmingly positive for the second quarter of this year. Waiting for CSX, which is, of course, a major rail line coming out after the close today. The VIX is a little bit higher this morning, 1397. The dollar index just over 100, holding just above it, much like yesterday. Yesterday was at 100.2. Today it's 100.42, up a little bit. And the yield on the 10-year now creeping back to the upside here. 3.74 yesterday, 3.8 today. That's almost 25 basis points, which is what we're expecting for the FOMC release on week from Wednesday, 6 days from now, the FOMC meeting. As always, we ask that you hit the lucky like button, share, comment, question, feedback, heckling, and love are always welcome here on the Market Prep. Make sure you subscribe to our YouTube channel so you can get notified when we do go live. It is always a pleasure to be with everyone this morning and every morning. Will, first in the room, winning the prize. Tachyon, good morning. Duke Shaw, Scott saw and he conquered. Coulter, learning every day. That's a great thing. I love to hear that. Jimmy, my brother Rick with us this morning. The Randolph to my Mortimer. I love you, buddy. Caprice, Theo, good morning. JD. Sarah Hall, prayers and love as always to you. The Rooster with us, being beaten by Will this morning. Good to see you, though, Rooster. John, good morning. Will, good morning. Michael, Jim, Travis, James, Jimmy, Jims, Robert, good morning. Stephen, Alfred, Colby, Nasdaq, David G. DeSobel, good morning. Don Clemens, wet and soggy South Florida. Yikes, it's dry here and probably a little bit cooler than it is down in Florida. I was in Florida, I think, in the beginning of June, and man, it was hot down there. But you stay close to the water, and you stay cool. A bunch of recalls, also. Michael, Josiah, good morning. Trading research, Rob T, good morning. John, Sean, if you're new to the market prep, welcome. We're glad you're here. We're going to see if we can't work together and find a little bit of where these markets are, what they're trying to do, how good of a job they're trying to getting there, and see if we can't put these markets in some sort of usable context this morning. It's always a challenge. We never know the outcome of anything. These markets are their own environment. We have to remember we are in the market's environment. It's not in our environment. So we'll look forward to seeing what we see in these charts here. Just trying to think. Another, I thought, great session yesterday in group coaching. If you haven't come to group coaching, definitely come join us. I thought there were some really good questions, emailed and on the fly. Another good session. I really enjoyed doing those and having that extra time to spend with traders. One of my favorite things to do is talk about trading with traders. We used to joke on that trading floor, like if you saw a bunch of traders at a party or somewhere after the close or in a bar or whatever, it was always, we spend all day in a circle yelling at each other. And even after the close or in parties and bars, you would always see traders standing in a circle yelling at each other. It's just something that would always seem to happen. Why don't we go ahead and jump into the charts here real quick? So here's the S&Ps, the daily chart. Obviously, the market is moving higher. It has been at times doing a pretty good job of it. We had a little bit higher volume yesterday. However, we lost an open interest. So the auction to the upside yesterday, while it looks good on paper, didn't perform all that well overall. That loss in open interest on this high here yesterday kind of brings a little bit of doubt to the continuation. And we started thinking yesterday or the day before that this market may be getting a little bit too long to rally. Well, what does that mean? Well, when multiple time frames are already holding long positions, there's few people left that are capable of adding to those positions, of bringing new business to the upside. And it started to look a little bit like that was coming true yesterday. Take a look at the 30-minute chart here. All right. So, yeah, the market opened and it started rallying right away. There was a gap close on the open that became supportive. We did see the market kind of pull back after what came out yesterday at 9 o'clock. Nothing, but at some point it looks like the market just ran out of buyers up there. It didn't produce any big divergence in delta. It seemed like people were still trying to buy this market, but kind of running out of steam. So it did close higher. That's a good thing. Value was outright higher. Range was overlapping to higher. Looking at the daily chart here, we had 3 up days in a row here in the S&Ps. The Dow, however, has 4 days closing higher in a row. That's kind of a change for the Dow here, and it did close yesterday at higher level than we've seen in quite some time. So the rally isn't over. I don't see that there's any real bad news that's going to change anything that much, but it may be due for a bit of a pullback or a redistribution of positioning. It might be getting a little bit too long to rally. Now, that can certainly change as things do. At ACH, anything can happen. If we can bring new business into the marketplace, and I believe that there's a lot of money still on the sidelines, they're waiting for the market to provide some sort of a pullback. Finally, we may get that if we're a little too long to continue to rally. Here's that 30-minute chart again. Overnight inventory, maybe getting a little bit short, but I would say largely flat. The market is offering us an opportunity to come back and repair some of the weak structure here from Tuesday. I know our friend Fred Decker was talking about the fact that it didn't look like a very confident rally on Tuesday. So it looking like if we may open with a gap. There's one nuance. If we can't close the gap relatively early, we'll look for opportunities in the direction of the gap, which would be to the downside. Here's the TPO chart. Oops. That's the composite chart. So yesterday was a normal variation. I'm giving it an extreme day because the TPO point of control was here. Volume point of control was up here. It may not be necessarily presenting as correct at this time. But the market, peaked out both sides of the initial balance. Neither of those auctions were very successful. We ended up, I think, really having kind of a hangover day yesterday after the rally on what day was this? Tuesday. Now, is this a confident rally? Well, a confident rally doesn't leave too many holes, doesn't leave anomalies like the way we did here on Tuesday. So it would make sense that the market may want to come back and finish out any unfinished business from the range on Tuesday, which would constitute a pullback, and maybe do a good job of adjusting inventory, perhaps enough for the market to continue its push to the upside. Initial balance yesterday, neither was the extreme. But, every time the market tried to auction away from this area, it failed. Now we're going to be opening outside of this area of balance. That this is going to be viewed as potential acceptance of lower pricing. So we'll have to see if we can close the gap. If we open outside of the range from yesterday and reaccept inside value from the range yesterday, that puts forth a value area special situation play, which means upon acceptance, which is subjective, of course, that's going to maybe make it so the market can rotate throughout the day and eventually reach the high of value yesterday. So a couple of nuances I'll be focusing on in the S&Ps. Are we able to close the gap? If we close the gap and it becomes resistance, I'll still look for opportunities to go in the direction of the gap. Any signs of acceptance inside range and especially inside value yesterday, the idea for shorts will probably be out, and the new hypothesis might be value area special situation. Reacceptance inside yesterday's value increases the odds of at some point during this day today, price reaching the upper extreme of value from yesterday. So a couple of interesting nuances. Even if you don't trade the ES, it might be worth kind of paying attention to these nuances just to see how things played out today. It's always a kind of a good idea even if you're not participating, to be paying attention and learning something from the day. All right, here's the Nasdaq, the daily chart. 1, 2, 3. Kind of a doji 4, 5. We've been coming up here for a while. We struggled yesterday at weekly kickoff high. Volume was higher yesterday. We increased open interest yesterday where we lost open interest in the E-mini S&Ps. Always something a little bit different, right? Right? Always something a little bit different. So we failed an auction above weekly kickoff high. This is some pretty decent excess on these daily bars. Remember, auctions usually will die in excess, and we're seeing evidence of excess on the daily chart with these long shadows up against an important inflection level. Maybe the market's too long to rally. Here was yesterday. The market opened, looked above, did a valiant job of trying to accept above weekly kickoff high. It just couldn't, and ended up actually closing lower in the Nasdaq, where the S&Ps closed higher. Dow closed higher yesterday. The Nasdaq closed lower. Settlement is right here, 15,959 and a quarter. Overnight inventory is short. We are going to be opening with great probability with a gap, and that puts us into repair from the day on Tuesday. Remember, on the S&P profile, it wasn't showing a very confident rally to the upside. There were some nuances that say that, the market rallied. It was a strong day, but how well did it really perform? Well, according to the profile in the S&P, is not all that well. So here's our gap, overnight inventory short, rejection of higher pricing above weekly kickoff high. Here's the TPO chart. Normal variation day. The initial balance, neither the high nor the low. Neutral stance. And here's the profile from Tuesday's rally in the Nasdaq. Lots of holes, lots of potential for repair. This point of control down here would be an obvious visual target for the downside, and then possibly an opportunity for us to look for an execution down at that level. All right. Here's the crude oil. Crude expiration is today for the August contract, so we won't have to deal with rollover for the next couple of weeks in crude oil, and won't that be nice? So it's, centrally located, open interest. The loss yesterday of 60,000 contracts, almost all of that is purely rollover based. It's not directional. We talk about rollovers and how the longer time frame traders tend to try not to get directional. They did a pretty good job this time with being not directional during rollover. And again, that ends today. We should be trading the September contract. Make sure you've done that already. Where is price? Well, it's relatively centrally located, somewhat in last week's range, inside weekly kickoff high and low. Just short time frame controlled because of the longer time frame is focused on rollover. Again, expiration is today. Anything can happen. Take a look at the 30-minute chart here. All right. Here's our rejection yesterday. What's this daily bar look like here? A lot of excess. Kind of a weak high over here, though. Here, back to the 30-minute chart. Overnight inventory, no. Don't really see much. Maybe a little bit longish. Market's still in range. Is it in value or outside value from yesterday? Overnight low looks like an interesting opportunity for us. I mean, there's some excess down here on this move to the upside from Tuesday. Wednesday's low looks interesting. Overnight low looks interesting. Overnight high, I don't want to play with because that may kind of indicate that we're kind of staying in value from yesterday. The market just opened and drove right into value from yesterday. So I don't really want to be looking for shorts until I get better trade location according to the range from yesterday. Here's the TPO chart. So what did we do yesterday? We left a late spike. I'm calling this a late spike. I mean, it happened at the end of the day, didn't have time to show acceptance through time at the end of the day yesterday. We opened basically right almost at the base of the late spike right here. We've been driving higher ever since. This is indicating possible rejection of lower pricing. So I'm not really thinking about the shorts here until we see some meaningful participation below this base of this late spike, which by name is 75.54. 75.54, write that down, important level for the crude oil today. And if we can't take that out and show some, again, meaningful participation below that, this is, at least early in the session today, exhibiting a rejection of lower pricing. Take a look at the TPO chart. It may be a little bit, well, this is the TPO chart. So this is, I think, probably your best picture of a possible rejection of lower pricing based off the base of the late spike. All right. Take a look at gold now. So, kind of what I was expecting to happen after the feeble breakout in open interest on Tuesday. Wednesday, really just a digestion day, just market showing through time that it's accepting possibly higher pricing. We get a pullback to weekly kickoff high here, which is 1972. This might be a kind of an interesting opportunity for price to come back down to that level. We added 2,500 in open interest yesterday in an inside day with really just dead volume. The volume just cut off yesterday. So I don't think that's a very good sign for upside continuation unless we can see some new buying coming into this market. This is the day that we added open interest. We lost open interest on this day. This was a complete repair day. We're going to see that on the profile. And this is, typically sometimes what happens when we do open inside a double distribution trend day. What are we looking at today? Well, we got a little bit long. We evened out that. Looks like we may be looking a little bit to the short side now, but the market is already open. We're seeing, possible rejection now of higher pricing. My dream position, my dream spot to take a trade would be somewhere between yesterday's low and the value low from Tuesday and the weekly kickoff high here. This looks like a very target-rich environment, if you will. So stay patient. I mean, the market did open in range and in value, so better trade locations are likely to come as the day goes on. So yesterday, talking about a repair day, the market opened right in the low volume, low time area here. When the market does that, there's a probability of repair, which means that price will come down to an assumed point of control in the lower distribution from the previous day and an assumed point of control in the upper distribution from that day. What did we do yesterday? We traded to an assumed point of control and we traded to an assumed point of control. We just fixed the hole in this profile and we're still in that area. So that also tells me, but stay patient. You're better off staying patient. 1972 is weekly kickoff low. When we got even close to it yesterday, it was rejected. We'll see about what happens there today. Value low from Tuesday, 1973. The low yesterday, 1973.20. Interesting spot down here. Interesting spot. Take a look at the euro now. All right. So big rally when the dollar was breaking. It's really just been an indecision since then. Mostly kind of range bound. Volume has maintained relatively well. We added 1,500 in open interest to the downside yesterday, looking like we may be seeing some more downside continuation today. Really kind of at the low end of the area of potential balance we've got here. Here's the 30 overnight inventory now short, although the market did open in range and in value. So I'm looking for better trade locations as the day goes on. But I don't want to fight this downside move here just yet. I think that there's too many weaknesses down below just to really kind of look at this as an opportunity, although it's not terrible. We've got a gap that remains unfilled. Gaps love to be refilled. We've got a naked point of control here off a day that was very toothy, a lot of weaknesses in structure on this day. So if we reject this area of balance, I think that there's some legs to the downside. I'm having trouble locating a place to limit risk. However, yesterday, a double distribution trend day to the downside. I don't think any of these markets left either extreme of the initial balance at one side or the other. Don't see that very much. We've been kind of keeping track of that. I've almost collected 30 instances, and it's right around 70 to 71% of the time you have one daily extreme, one day session extreme at one of the extremes of the initial balance. It happens a lot, but not today. The market opened, traded to point of control. Now it starts to look to the downside, possibly to fill this gap, possibly to fill some of the weaknesses in structure here from what day was this? That was last Wednesday that we started to really kind of break to the upside. And there's also another gap here and lots of visuals down below. So there's appears on the charts to be some unfinished business at lower levels and really kind of rejecting last week's high here on Tuesday. This seems to be very important. It was weak highs, finally some excess, double distribution trend day. I think that the tide may be changing here for the euro a little bit. Take a quick look here now at the 10-year. Well, we see rates popped up a little bit today. Makes sense that we've taken a look and driven lower. We've had virtually no acceptance above weekly kickoff high. This is so important. And finally, it looks like we've got some decisions being made, possibly in longer time frame, with our drive away from it. Finally, it took forever for these folks to make some sort of a decision. ZN 30. So there's that weekly kickoff high. Rejection. Continuation to the downside. We do have lots of visuals to go back and repair down below. Very similar to the euro, kind of a pivotal area here. We've got our first visual target, the point of control here from last Wednesday, and then another gap and a point of control right through the gap, another one down here. Really kind of looking on the moving averages here as well. We're starting to see the 50 come across and now below the 100. We take that 50 and get below the 200 session. Be some confirmation, unfortunately, bad trade location based off that information. Here's the TPO chart. Again, weaker highs, excess on Tuesday, excess yesterday, weak lows. Market kind of telling us it's finishing upside auctions now and not finishing downside auctions. Makes sense that we're taking a look to the downside. Here's some of the repair that would be needed from last Wednesday, the gap here, prominent point of control here, and knowing that rates are probably going to be going higher next week, it makes sense that the price on the 10-year has begun to fall to the downside here. So, all right, let's see what we've got here. You guys giving the rooster a hard time. Just don't sneak up on me. Hello, the name of the order type I mentioned yesterday was iceberg, and the other one was growler order. And if you want more information on that, hello. We did kind of go over that in coaching yesterday. If you want to send me an email, I'll send you a recording of that coaching session yesterday, where we discussed the different types and the difference between iceberg orders and growler orders. I'm going to drop my email. Yeah, you bet. Here's my email, folks. And if you want the recording from yesterday's group coaching session, and we did again talk about those different types of orders and how the longer time frame traders try and hide their activity because let's face it, you got 10,000 mini S&Ps to buy. You can really mess up an execution like that. No problem. It's a really diabolical thing that helps the longer time traders kind of hide their activity. People can sniff out iceberg orders. A lot of the way I do that is through Delta. If price is moving opposite the more aggressive traders, usually means there's iceberg orders involved. The growler order, Jack is like they'll place an order to buy 10 on the bid. The second it's filled, they lift 10 on the offer. So they keep Delta neutral. So it makes it much more difficult to kind of sniff them out. Right? Okay. We are continuing to work as asking about Top Step TV. So we can't hear you, Coach. Can you guys hear me now? This is one of the things we're doing to continue to get better for Top Step TV. Sure. Delta insignificant. A lot of times it is. Echo. Terrible echo. Huh. I only have one mic on. Well, see, this is why we are too much reverb. All right. Well, you know what? Let's just call this a prep. Take your deep breath. Stay humble, grateful, creative, and centered in your trading. Try and keep the echo to a minimum, and we will see you soon. Have a great session. Get out there and profit today. We'll see you soon.